Hello, everyone. Today on the Final Bar, I'm joined by Frank Cappelleri from Instinet. We'll talk about this market environment. We have talked about the warning signs that have been emerging in the last couple of months, sort of all came out in a big way today with Facebook dropping. But that ended up being not even the main story today. Is overall this broad distribution with so many things rotating to the downside, a defensive feel to the leadership with consumer staples and healthcare. What does this mean with the short-term sell-off relative to the long-term trend? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the toolkit of technical analysis, using price, trend, momentum to better understand what investors are doing, how they're voting with their capital. Price tells us a great deal about the psychology of investors, where they're leaning, what they're afraid of, what they're excited about. And when you see the market move lower like it did, particularly the NASDAQ down almost 4% today, NASDAQ 100 down over 4%, it tells you a lot about the headwinds, I think, to the growth trade, things we've talked about for quite some time. So I always tell people on a day like this, the magnitude, the severity of the sell-off may be surprising. It may be quite uncomfortable depending on what you own in your portfolio, but hopefully the direction has not been a surprise because we've talked about some of these challenges. We've talked about how days like yesterday feel a little unusual where you have growth stocks kind of working okay, given all the potential headwinds that we have to that trade. Today sort of feeling as how I would expect the market to behave at some point, given a lot of the uncertainty, and again, particularly the uncertainty tied into interest rates. And I would remind you that most investors, many investors, including any new investors in the last couple of years, have really not experienced a rising rate environment. Many have not experienced a real bear market before. And the challenge is when those things, if and when they would start to manifest, could be an exciting time for a lot of investors. We have a great schedule of guests here. I'm excited to talk to Frank Cappelleri from Instinet here in a few moments. Next week, 3 solid guests for you. On Tuesday, the 8th, we have Sam Burns from Mill Street Research. On Wednesday, the 9th, Carolyn Boridan, the Fibonacci Queen, joining us on the show for the first time. On Thursday, the 10th, Ryan Dietrich from LPL Research does a great job thinking about the long-term perspective and where we should potentially be focused. 2 other quick events to let you know about. First off, we have the Money Show Virtual Expo next week. This is a money show focused on the cannabis area of the market and cannabis stocks. I'll be doing a presentation with Greg Schnell called Trading Cannabis Stocks Using Price Momentum. I talked with Greg earlier today. We're sort of strategizing about how we're going to approach this session because the problem is for a lot of these cannabis names, the charts are pretty ugly, right? Tickers like MJ and YOLO in significant downtrends. So what we're going to do is just talk about the overall market environment, why it's not particularly ideal for some of those names, but we'll also look at some of the agriculture stocks, seed stocks, and others that have actually done very well and relate the weakness that we're seeing in some of those cannabis stocks to what a proper uptrend and rotation to an uptrend could look like for those names and what we should all be looking for. Go to stockcharts.com/moneyshow to sign up for that event. I will be doing the next webinar from Market Misbehavior coming up next Tuesday, February 8th, 1 o'clock Eastern. It's called Breaking Down Breadth. There's a double meaning to that title. Breaking down as in digging into them a little deeper, but also breaking down as in the conditions have gotten a little bit weaker. So go to marketmisbehavior.com/breakingdownbreadth to sign up for that event. Let's continue on with our market recap. Today is brought to us from Tradier Brokerage. You can go to the StockCharts ACP platform. In the lower right corner, you'll see the little Tradier logo, an arrow to the upper right. Click on there for more information on how you can trade directly from StockCharts. We talk about the market recap. I feel like yesterday and today, 2 very different feels to this discussion. Now, one consistent theme is the fact that defensives were a big part of the leadership or the at the top of the leaderboard, if you will. Yesterday, you had utilities and real estate, if I remember right, 2nd and 3rd on the list. From the top, doing very, very well as the market was pushing higher, and that gives you a little bit of skepticism about the the up move, right? When the market's moving higher and it's really dominated by some of the defensive stuff, it doesn't particularly feel well. Today, very much a reversion back to the downside. It makes this recent bounce higher in stocks feeling like a bounce before the next leg lower, and today could be the beginning of that next leg lower. Again, talk to Frank Cappelleri a bit, see what he thinks about this sell-off today and how that relates to what we've been seeing in the last couple of weeks here. But just to catch up on what happened, the S&P down 2.4%, got up to 4590 yesterday, now back below 4500 going into the close, and really accelerated to the downside in the last hour or two of trading. The NASDAQ composite was down almost 4%. The NASDAQ 100, the Q's down over 4% today. So one of the worst days we've seen in quite some time. Mid caps and small caps down, but not as much as the broader S&P. And the VIX, which has been coming off significantly from the low mid 30s down to the low 20s, now bouncing up and touching just above 24 today at the end of the day. Interest rates moving higher today. The 10-year yield finished today around 183. It was a little bit higher earlier in the day, but overall, this has been a broader rotation, away from bonds, sort of weaker bonds, and interest rates moving higher. The dollar index, by the way, down 0.5%. If you use the UUP, that weaker dollar environment, I don't get a chance to talk about it in too much detail on the show, just given the limited time we have, but I would just encourage you to look at what a weaker dollar might mean. If you do continue to see downside pressure there, it means a lot about U.S. versus non-U.S., large versus small. There are a lot of potential implications of a stronger or particularly a weaker dollar, which we're starting to see here, potentially 2022. Gold price is really choppy if you look at the GLD. Spiked the lower out of the open today, finished not too far from where we closed yesterday, just 0.2% lower. Silver price is down about 1%. Commodities as a whole doing okay, and energy prices were higher if you're looking at crude oil. Cryptocurrencies very much a mixed bag. Now, while stocks were rallying yesterday, cryptocurrencies actually were continuing to weaken. Ether down another 2.3% today. Bitcoin about 1/3%, which is not too bad, but back below 37,000. Let's look at the chart of the S&P. We review most days during the market recap. I'm very interested by the relationship of the movements in stocks here. If you look at the high from early January, if you take the low from about 2 weeks ago, you get this sort of framework from just above 4,200 to just above 4,800. If you look, that first jump higher was to 38.2%. We've then continued through that, and yesterday really finished almost right at a 61.8% retracement of that January sell-off. So, it's a very poetic way that rally could peter out if we hit the 61.8% retracement level and then start to rotate lower. Having said that, again, let's remember that a downtrend is made by lower highs and lower lows. This is, I think, once again established a lower high. If you take the high from early January, the high from the second week in January, and now beginning of February, we're doing this stepwise motion down to the downside. The question for stocks, can you establish a higher low, which is what it's not really been able to do. We do see further distribution, Friday going into next week. I think 4,300, this amber shaded area, continues to be an important one. The previous lows are around 4,220. That's where we hit in the sort of mid-late January. Those are some important levels to pay attention to. The 38.2% retracement of this larger move higher, which topped out at 4,800, is right at 4,200, right? That's the 38.2% retracement down. So you have a lot of indicators sort of pointing in that 4,200 to 4,300 range. I think that's a reasonable level at which to reevaluate things. We were unable to get below there before, and you saw buying power increase, and you saw prices going higher. But as we rotate lower, I'm naturally looking at some of those key support levels. Can we put in a higher low here in the next week or two? That would be the real question, I think, for the overall trend characteristics of the market. Looking at sectors, communication services, big time dragging on the performance, down over 6%. Obviously, had Facebook gapping down in a fairly severe way after earnings this week. You've had 4 or 5 of the FANG stocks in the last weeks. We have Amazon after the close today right now. So a lot of potential catalysts. And the good thing about earnings season, there's a lot of potential catalysts for prices to go higher. I've seen that happen where the market's sort of choppy, and you get some really good reports that cause investors to get a lot more confident about upside potential. But the other side of that coin is earnings can be a very big downside catalyst as well. That's what we saw with Facebook. That's what we're seeing with some other names as well, as they gap lower after their earnings release. And while that I don't think is the only story, I think there's a broader set of narratives, set of themes to pay attention to. It's just one more data point suggesting that under the hood, the market's a little weaker than the averages might have been telling you. At the top of the list today, you have consumer staples flat for the day. And it's interesting, I was looking at the chart of Coke earlier. I'm often asked in this sort of environment, where do you go? What opportunities do you find in an environment when it feels like everything's starting to struggle? There are certain parts of the market, obviously, that have been doing very, very well. Energy comes to mind, utility stocks, things like National Grid that have had really good runs, but agriculture stocks, I was talking, as I mentioned, with Greg Schnell earlier about things like Monsanto and ADM and others that are actually performing very, very well. Coca Cola, not a bad chart, right? And if you look at these, if you look at the chart of Coke, you wouldn't think that the market is in sort of a disruptive period. It's sort of shrugging off the broader market environment and overall making new highs today, making multi-year highs today as the S&P is selling off. So that's the good news, is that there are charts like Coca Cola. The bad news is I don't feel great when charts like Coca Cola are the juice. Those are the names I just mentioned are utilities, Coke, like these are fairly defensive part of the market. It shows you that people are rotating there. But again, I don't really get excited about owning a chart like Coca-Cola unless I'm trying to hide from other things that are really struggling. So I think if you look at the broader implications of names like this doing well, it can be a bit of a concern. However, it's worth noting in any environment at all time, there are usually stocks making new highs, stocks making new lows. So it's a really good time to scan and see what's holding up given the market uncertainty. We need to take a quick break. We'll be back with today's guest, Frank Cappelleri. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the market environment using the power of stock charts, using data visualization techniques to better understand what is happening in these markets. A couple quick announcements before we get to today's guest, Frank Cappelleri. First off, we welcome your questions. We had a great mailbag segment earlier in this week on Tuesday. We'll do another one on tomorrow's show on Friday of this week. All of those questions come from you and our other viewers, sharing questions, things you're running into as you are trying to analyze your own charts, questions on technical analysis, on market history, particular tickers, ETFs, whatever it is, we'll do our best to point you in the right direction. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also go to stockchartstv.com. That's our on-demand platform. Great guest perspectives like Frank Cappelleri and so many others that come through the Final Bar and our other shows. Special events like The Pitch, our Market Outlook series last month with Larry Williams, Martin Pring, and many others sharing their perspective on the year to come. All of that for free at stockchartstv.com or on your mobile device. Just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Frank Cappelleri. Frank comes to us from Instinet in New York, one of my favorite technical analysts who does a great job bringing some charts that help us think. Frank, welcome back to the show. It's good to see you.
Thanks so much, Dave. Great to see you as well.
So I appreciate your courage and your willingness to come on the show and on the day when the charts are evolving real time as we're preparing for the show. But help us put what we're seeing in a proper perspective. Volatility has certainly been a story with some elevation so far year to date. Start us there. What are we seeing?
Sure. Well, we've come across so many studies in the last few weeks about how bad things have been and when it was this bad before. But one that really struck me when I was putting it together was this one, where you had the S&P 500 down 5%. The same week, the VIX was up 50%. Now, it may not seem that rare, but it actually is. And going back to 1990, it was only the 7th time it's happened a few weeks ago. And every single time, including this last week, the market rebounded. And so that tells you a few things. One, it shows you that volatility is always a two-way street, right? We know that, but we typically hear about the VIX popping when the market's going down a lot. But as we know, large declines bring large gains as well. So it tends to give you a sense of how wild things can be on both sides, and we saw that play out. Now, I think it's much more important to see what takes place after that. And this is interesting. We have 5 of the last 6 instances here. The only one that's missing is 2020. But the biggest thing to take away here is that volatility tends to arrive and it doesn't just leave right away. And we can see how this played out quickly, going through all of them here. 2018 and the vol implosion and in February and March led to a rally. But as we know, toward the end of the year, had the big fourth quarter sell-off. And then going 2015, same thing. 2015 started relatively quietly. We got that big downturn in August of that year. That led to 6 months of really volatile back and forth action. Didn't have a low there until February of 2016. In 2010, that started with the flash crash. Remember that on May 7th. That led to 4 or 5 months of really, intense buying and selling. Had a nice rally there in 2011, but as we know, a few months later, there was the volatility of 2011, which basically went from August to December. And finally, of course, back in 2008, and it happened right in the middle of that bear market. That week was October 10th, and S&P was down 18% that week alone. So really, if you were living through that, as Dave, you and I were, and we survived, but it felt very like capitulation then. And we know that it wasn't until 6 months later until things really started to turn. And so we're going to get a lot of whipsaws, I think, over the next few months. But I think it just tells you there's no rush for this, right? It's always enticing to try to call the bottom, try to catch a falling knife, but really until we see momentum turn, until we see bullish patterns really form across the major indices and the sectors, that's, I think we have to be patient until that type of environment presents itself.
You mentioned we both survived this. I would not describe that period as particularly comfortable, but you're absolutely right. We made it, right? We survived through it.
Right.
Switch gears a little bit. One group that actually is performing pretty well, natural resources. What attracts you to this chart?
Well, this is another example of, you can see what it did from 2014 to 2020, right? A downtrend. And so we tried to pick the bottom there. There were some periods of time when it was rallying, but really didn't have a sense of a very substantial bullish pattern building and breaking out until now. And so this is a great example of something that should be working, right, in an inflationary environment, and is. So I think another thing to look at here is that if this breakout continues to hold, if we continue to have advancing price action, eventually get to that price target, it probably tells you that inflation is still out there, right? Many technicians, of course, I would say, saw commodities rallying and saw these bullish patterns form, way before, Chairman Powell just decided to change the language of what is going, the Fed looks at. And so we're going to get some indications, I think, over the next few months in looking at a thing like IGE to get, to see if inflation is still going to be with us.
Your next chart, by the way, is the relative strength of that group, which certainly has rotated from a long-term downtrend, arguably, to more of an uptrend, right?
Right, exactly. And, on a monthly basis, momentum works the same way. So I think it's very interesting to see this and see what the 14-month RSI indicator was doing at the same time. If you should look at the area from 2003 all the way to 2009, as the market was, or as the IGE SPX ratio was moving higher, the momentum stayed between mid-range and overbought. When the downtrend was with us, the complete opposite was happening. So right now, that monthly RSI is at its highest level going back at least 10 years. So that's going to be another indication of whether this breakout through that steep downtrend will work out or not.
It's so funny, Frank, as you're talking, I'm realizing a lot of people looking at like 1-year charts, it feels like these stocks have had such a run, and that's true, but put that in the context of where they've come from, and it could certainly be early innings on something like that. We only have about 30 seconds left, but I did want to get your last chart, which is the ARK Innovation Fund. What is this telling you?
Another way to say caution, a cautionary sign here, not to always buy the dip or something just because it looks like it's lower. ARK is down about 50% from its high. That's big. However, if we tried to buy this, we would have gotten burnt numerous times. And as an example here, there are 6 different 20% declines in here over the last year. So even though you're buying at a lower price, just by mathematics alone, we know that 20% move can come pretty quickly is there too.
That's great. Prices usually go down for a reason, I was taught earlier in my career. Frank, listen, it's awesome to see you. Thanks for sharing some charts with us, particularly the long-term perspective. Super helpful. Stay safe there, and we'll talk to you again soon.
Thanks a lot, Dave. Always a pleasure.
That's Frank Cappelleri. Frank's coming to us from Instinet in New York. I love that, some of those charts. And again, I made the point, I hope you caught it, when he was talking about natural resources rotating higher. I think for a lot of charts that are rotating up, things that feel like they've had really good runs, my thought would be if you back them up a little bit further, it's always helpful to bring in a little more data, understand the long-term trajectory. Also, that last chart is just such a great comment. I was taught, don't confuse the bottom of the page with support, which I've mentioned before on the show. Just because things have gone down a lot is usually not a great investment thesis. Looking for signs of accumulation, that is something I can get a little more excited about. Great take there from Frank Cappelleri. Let's continue on today's show with our next segment, Getting Sentimental. A lot of the weekly sentiment data is updated Wednesday into Thursday. So that'll be a good time to check in and see where some of these indicators are at. We might touch on a little bit of breadth as well if we have time. We'll see what the clock will tell us here as we go through the charts. But usually when I think about sentiment, it's in three sort of general buckets. First is volatility and looking at the VIX. The second one would be survey data. So we have things like the AAII survey, the NAAIM exposure index, which tell us a little bit about what people are saying in terms of how they're positioned and what their perspective is. Then finally, we look at the options market a little more closely, look at put-call ratios and see what sort of patterns emerge. When we start with the VIX, I really like Frank's chart looking at that relationship, seeing the spike in the VIX and what it really means. And I think we're starting to see that scenario sort of play out, right? You had the beaten down market, you have the stock market selling off pretty significantly, really turned very quickly going into year end, and then January beginning, rotating lower, but then bouncing higher in the last week in January. The VIX on the way down got above 30, and it's not often that we've been there if you look at the last 18 months or so. And I take this huge spike out of the picture, which was the February, March 2020, where it was an incredibly elevated volatility scenario. From there, you sort of settled into this range. Getting above 25 was extreme, getting above 30 fairly rare. The last time we were this high was in December of 2021, in May of 2021, in January of 2021. So it seems to me, all right, well, those seem to be incredibly buyable dips. All we need to do is for the VIX to get above 25 or so, and that's a buyable dip. And that strategy works until it doesn't. And I was talking with Mark Chaikin earlier today. We had a great discussion about the markets and what we were seeing and what sort of things we were looking for. And we talked about volatility, but talked particularly about these conditions that we're seeing with volatility and with breadth. If you compare what we're seeing right now to the last 12 months, I think you would very easily get drawn into the idea of buying on the dips, because that has been an incredibly successful strategy for 12 to 18 months, really since, April, May of 2020. However, that works until it doesn't. And that last dip, when you try to buy it, you get absolutely crushed because that's when something really negative can happen. That, if you think about it, this is what the beginning of the February 2020 sell-off felt like. You had that initial sell-off and then that bounce, and it felt like another buyable dip, even though we undercut the previous lows. As we know, that ended up turning into something more negative. So I can't guarantee we will relive that sort of scenario from March 2020, but I'll tell you there's a non-zero probability of that happening, and that's what I want to be protected for mentally and with the portfolios. Thinking about what levels you would need to lighten up and where you would want to move more defensive if you're not there already. So the VIX certainly has become elevated, remains above 20. One of the things I mentioned in a market outlook at the beginning of the year was that the VIX would spend more time above 20 than below 20. So far, that seems to be playing out pretty well. We have a lot of year left, but it's an interesting start to that thesis. Second chart we'll look at is the AAII survey. We focused on this last week because there was such an increase in bearishness. The bearish rating got below 50%, which is actually pretty rare. If you go back in the history of the indicator, it's not often that you get below 50%. It has happened in certain bear cycles, though. The spread between bulls and bears was right at 30%, which was the most negative it's been since May 2020. And before there, you have to go a couple years back earlier in the teens to find examples previous. I think it was back in like 2015, 16, if I remember right. It may have been 2018. Nope, it wasn't, because that's right here. So probably 15, 16, if not a little earlier, when you had the spread that negative. Right now, though, it's bumped back up a little bit. You had bears come off of it, I think, drawn in from the bounce in stocks that we saw at the beginning of this week. Bulls just a little bit higher, around 26.5. Bears still around 43.70. So far more bears than bulls, which is what I would expect given the severity of the sell-off that we've had. And overall, this is a sentiment picture that looks a lot more like corrective patterns than any sort of buyable bounce from what I would see. Now, an interesting move in this next chart. This is the NAAIM exposure index and the RIDEX flows. And the name exposure index looks at active investment managers. They can say what their overall positioning is to equities. It's up a bit, but still, I think the main story is the fact that for the last 3 weeks, it's been around 60% or lower, which is actually pretty low. It usually doesn't get down in this level and then bounce higher. That's actually pretty rare. Usually this is a much more of a defensive feel to the tape. And the longer it remains below 50% or 60%, I meant, then the more weak of a positioning this is implying. Even more significant than that, though, is the RIDEX flows at the bottom. The RIDEX flows have been at incredibly low levels. Now, I have this plotted inversely so that it lines up a little bit more with some of the other sentiment indicators we looked at. So very high on this chart basically means that it's a pretty low level. And what that implies is that investors are all in on the most bullish positioning. Really, if the red lines are very close to the zero level, that tells you investors are all in bullish in the RIDEX family. If the lines go very, very far down from the zero line, that tells you they're more bearishly positioned. And right now, they're basically, were very, very bulled up about 6 weeks ago. And look at how quickly that has changed. It's not often that you get that sort of significant increase in the RIDEX flows, and basically meaning that people are unwinding aggressively their very bullish positioning. So this is telling me that investors are getting more and more defensive in the last couple of weeks. And that mirrors the fact that active money managers are sort of doing the same. So a big stomp on the brakes from those sentiment indicators. Very quickly, the pull call ratios very recently off of very, very high levels. That usually happens in relationship to pullback phases. You can see on the horizontal line where the current value lines up to some of these previous values. We're at some of those levels that we were in some of the previous pullbacks. Unfortunately, though, we're also at levels just before some further price deterioration happens. I think this is a time to be super diligent on defining risk, on focusing on levels of support on particular names, and also for the market as a whole. We need to wrap the show, go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1 is Facebook. I almost made it through the show without talking about Meta platforms, but I have to address it. Down 26% for the day. It was trading lower in the aftermarket yesterday. I was sort of preparing for this sort of move with what we were doing today. I just wanted to highlight the overall sort of symmetry or the performance of the stock going back to the March 2020 low. If you start the clock at March 2020, if you end the trend in September at 21, which is the high water mark for Facebook so far, you can see we've now chopped around and have been in a sideways trend. We bounced off of this 300 level, which actually served as support a number of times, also as resistance back here in 2020. And so pretty reasonable place to bounce off of that in the last week or so. We gapped lower, and we gapped actually down to just below this previous support level as well. These are the lows in September of 20, in January of 21, right around 240 to 250, we'll call it 245. This is now very, very close to the 61.8% retracement level, which is around 231. So if you take these horizontal lines and make 2 shaded areas, you can see how these support and resistance levels are a little bit expected, just given the trajectory of the chart, given the previous levels of support that we've seen. And so it's pretty reasonable that we would expect the stock to sort of gravitate to this range, which means as long as 230 holds, this chart is finding stability. If it breaks, I think you need to be concerned about much further downside for a name like Meta Platforms. Chart number 2 is the name exposure index, but in this one, I wanted to highlight the RIDEX flows at the bottom. This is quite a change that we've seen in the last 4 to 5 weeks, with the RIDEX flows being incredibly bullishly positioned, basically telling you individual investors in the RIDEX family were as bulled up as they had been in the history of this indicator going back for decades. All of a sudden, that is starting to unwind very quickly, indicating that investors are stepping on the brakes. And if you look back in time at when that's happened, that's been when the market started to really deteriorate. The more that this accelerates to the downside, the more that it tells you fear is manifesting itself and people changing their positioning. And that a lot of times can create a feedback loop where the market can roll over consistently more and more to the downside as selling pressure continues to build. Finally, I'll finish on a positive note. The S&P down significantly today. A lot of downside for a lot of names and a lot of rotation lower in growth stocks. I would tell you there are plenty of areas of the market that are actually holding up okay. I mentioned agriculture stocks, and I particularly focused on Coca Cola, KO, making new multi-year highs today. Folks, that's our show for today. Special thank you to Frank Cappelleri, joining us from Instinet, New York, sharing his take on the market environment. For StockCharts.com, I'm Dave Keller. Be well, stay safe, have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.